And we may need to go back to pre-2013-14, thereabout, where we had something similar. So what normally happens is this: anytime a government is borrowing heavily, it borrows heavily on government paper, short-term, long-term. When that happens, interest rates start going high. Here's what happens. So, for example, I have money in my bank, and the government probably is offering, because the government has a high appetite in terms of the borrowing it wants to do. It pegs an attractive interest rate on its paper. So when the government pegs an attractive interest rate on its paper, it simply means if I have money in the bank, I'm likely to go to the bank, get my money, and put in the government. So what the banks will do, the banks will try to match the government on the return which they give you on your deposit. Now, what that happens to the bank, it simply means the bank will have a high cost of funding. What bankers call a cost of funding. A cost of funding your book so that you can lend. So the banks have been at a mismatch for quite some time because interest rates have been going up on government paper. The reason as to why the interest rates are going up on government paper is because of the appetite the government has on borrowing. So that has been hurting banks. So it simply means, because of that mismatch, essentially the banks have to increase their interest rates so that they match the government paper on this other side. So it was bound to happen, it's only that it has been hiked rapidly. So when the MPC passed that, I was quite surprised because the hike was massive, biggest we've had in 11 years. But then again, if you look at the dynamics which are placing, the dynamics which are occurring in the market, it has essentially put the banks in a situation whereby they had a mismatch in terms of what rates am I lending at versus what rates am I retaining my deposits at. You've had people talking of capital flight. And it's primarily because of conditions within the market. Now, if you put the aspect of what I've just alluded to in terms of government borrowing, high interest rates on your treasury bills and treasury bonds, then the banks may have looked at that position and the consensus, because the Monetary Policy Committee is essentially a committee of bankers together with the CBK, and I suspect the consensus was that for us to cure this mismatch, we may need to increase the base lending rate. You alluded to the aspect of banks sending us emails, alerting us of increased interest rates on our credit facilities. That will definitely happen. Unfortunately, when that happens, it will simply means non-performing loans are likely to go up. Yields or return in which the banks make, as far as the revenue on assets are concerned, will maybe hampered as far as the local market is concerned, because you increase your interest rates and the market is not doing very well. You're crowding out the market because the banks will not be lending to the government. You're crowding out the market because if I had an installment of 50,000, probably you'll tell me my installment is now 75,000, and I may default. And if I default, you as the banker, you may not make money, and then that in turn has other effects as far as maybe return on shareholders is concerned, performance of the Nairobi Stock Exchange is concerned, and so on and so forth. So the move by the Monetary Policy Committee is just a reaction.
It's a reaction.
Exactly.
You want a reaction to what, Arnold?
Because
if you're looking at the inflation side of things, I mean, inflation has been coming down
year
on year when you look at it on a monthly basis. If we're talking about the Kenya shilling against the dollar, then you're saying, well, but it can't be a 2% increase in that. There has to be a gradual increase as you wait for things to stabilize. I asked you this question again. Just before we went on this particular issue, that this particular hike came after those two gentlemen that were sort of threatened by the budget committee at the National House, saying, well, we're going to fire you. You're not going to stop the free fall of the Kenyan shilling against the dollar. Is that, and you've seen this morning where Treasury Cabinet Secretary Njuguna Ndung'u is saying, but I can't sit here and teach you. If you want it to happen, then you got to know the basics of it. Is this a reaction to that particular threat? And if so, then should we question that move further than we are doing it right now?
I think we should question the move in terms of the movement. It's too rapid in my opinion. I think, as I mentioned before, the idea is to do things gradually.
Yes.
Because it's very rapid, again, you're likely to see adverse effects within the next few months.
That's it.
Because all of a sudden, if you have more non-performing loans,
Yes.
banks performing poorly,
Yes.
return on investment for the shareholders going down, the same banks on counters of the NSE being negatively affected. And then unfortunately, when you have such moves, you have things to do with the alternative lending, people now opting for alternative lending. Unfortunately, you may have auction of properties which are being held by the bank because of non-performing loans. So the effects are so adverse. The ripple effects for that particular move are very, very adverse.
Yes.
Yeah. And also access to credit. Credit will become extremely expensive.
Somebody said that now banks are moving into the Shylock territory
Yeah.
by this particular
that is true.
interest
That is
rates,
so
isn't
true.
it? I want to take a minute before I cross over to Maura this morning as well. If I indulge you, if you open the Business Daily this morning, which is just next to you right there, Arnold, and I know you've looked at a particular headline this morning.
Yeah.
It was saying that some counters at NSE are threatening to pull out because of a bear run that has been witnessed in this market. By the way, for those people checking, I want you to check this morning and see how much you're going to use to buy Safaricom shares today. Then the conversation begins.